So today we're going to talk about a popular growth stock that has just crashed after reporting earnings, and today I'm going to talk about that crash and potentially where I would buy this stock, because I do like it and it is a stock I would like to own at the right valuation, and today I will reveal that for you guys. Now normally on Friday I would say this is the last video of the week, but I am actually planning on dropping an extra video this weekend on the YouTube channel, so do keep an eye open for that one. And as well as that, if you do want some free shares, join Trading 212 with the link in the description, get a free share worth up to £100. But let's get onto this stock that's crashing at the moment, and that is Adobe stock. Adobe stock is currently down 11% in pre-market after reporting earnings last night. So this is a pretty decent drop for Adobe at the moment, but it can be a little bit of a volatile one off earnings. Now it is a 258 billion market cap and currently trades at 48 times earnings. Now I'm sure most of you guys are aware, Adobe, you can see this is my account right here. I personally pay for Adobe. Adobe offers a lot of editing software programs, so like Photoshop, Premiere Pro. There's a lot of editing softwares they offer, and these editing softwares are absolutely fantastic. They have a pretty good moat around that. No one can really get close to how good some of these programs are. And if you actually look at the reviews for a lot of these programs, a lot of them will all the time will give you 5 stars out of 5. They get the max reviews when they come to the critics. And personally for me, I can't really see myself moving away from Adobe, and it's one of those that they've probably got a little bit of a moat around them, because even if Adobe came out and said, oh, you know, we're up in Adobe Photoshop by 5% every year, you'd probably still end up playing it until it got absolutely ridiculous. So there is that stickiness around the programs that they are pretty much the best in the sector. There is cheaper alternatives out there, but they don't really come to the levels that Adobe does, in my opinion. So the programs are absolutely fantastic. However, the numbers last night did not impress Wall Street. Now they did beat on an EPS, as you can see here, and they did beat on revenue, as you can see here. The big thing was the outlook. They reported their Q2 outlook, or they gave the Q2 outlook, and Wall Street was like, we're not happy with it. You can see here the total revenue was to be a mid-range of around about 5.27 billion. That was below the consensus of 5.3 billion, as you can see here. And I think EPS as well, yes, as you can see here, was a little bit on the lower side to the actual consensus, and that's why the stock dropped. Now I guess this has always been the issue with Adobe in the last few years, is that it has kind of got to the point of view where it has reached big scale. There is always that time frame where if a company keeps growing and growing and growing, it is harder for it to grow at those higher rates, and I think Adobe has kind of got to that point. 11%, 11.2% is still very good growth. A lot of companies wish they could grow at 11.2%. But when you look at Adobe, for example, this is a company that historically has put in easy 20% growth, as you can see here, apart from this period of time here. And I think that dip there, as far as I can remember, is when they switched from where they used to, you used to be able to buy like Photoshop in full. So you go to the shop, you buy Photoshop, and you'd pay like £100 a year and you would have it forever. I think that's when they switched from that kind of model to a SaaS model where you would have to subscribe to use Photoshop. So it did have a short-term impact on the financials, and then since then it's been the dream of a SaaS model. This is where the SaaS model was created by Adobe, where you go, instead of doing that one-off fee, we're going to charge it a lot cheaper, but you have to pay every month. And that has led them to do very impressive growth, and the company did grow 20+% every year. Now actually in the last few years the growth has actually started to slow down. However, the CV situation did help it, but then the growth has gone and stayed more around the 10% growth at the moment. So the growth is slower than what Adobe used to have, but it's still pretty good, and I think a few people are kind of adjusting that, and there's that adjustment in the guidance at the moment. But I've got to say, you know, it's not crazy drops in the guidance. You know, dropping the guidance by only a couple of percent, I think realistically isn't that much of a major issue. I think the big issue is that when you're a company that's trading at these levels of 48 times earnings and you come out and you're only growing at this sort of rate, I think that's what the market's a little bit upset about. When you do look at the guidance for 2024, full year guidance is still at 20%, which is pretty impressive. Although next year does slow that growth back down to 11%. So we'll see what this company now decides to grow at going forward. I don't know if there's some price hikes why that's jumped up to 20% this year and then the drop down to 11% next year. But since the change to the SaaS model, you can see here Adobe used to trade at more towards a market average valuation. Since then it has traded a lot more towards the 40, 50 range, but there has been time frames where it has dropped into the 30, especially during the 2022 stock market crash, but it's gone back up to more of that premium valuation. But with Adobe, it's a high quality quality business. That SaaS model allows it to throw off a lot of profitability. It is able to buy back 25 billion worth of stock, which is pretty impressive. And when you look at the shares outstanding, there's sometimes some jumps in because of acquisitions. They do like an acquisition, which is what they did with the likes of Figma. They have had a little bit more competition in that has maybe hurt the growth a little bit, but they're still a clear market leader. But Adobe has looked more towards the acquisition route to try and strengthen up the company, the moat, and give them a bit more growth, and that's why they look to acquire Figma, even though that was recently abandoned because of the competition watchdog going, we're not going to allow you to have that one. But apart from the little jumps in from acquisitions every so often, because this company is a SaaS company and is able to throw off major amounts of profitability, that does mean they are able to buy back a lot of shares. We've seen them do that previously. And if you look from the likes of 2016, for example, you can see there's been a lot of shares that are being bought back, and they have even just announced another pretty big buyback with 25 billion stock being bought back, which is absolutely huge. So looking at Adobe, which has been nearly a 15 bagger since it has switched to the SaaS model, is there an opportunity to buy into Adobe now? Well, Adobe can have drops. We can see this here in 2021. It's still not actually broken its all-time highs from 2021, as a few stocks have. But you can see here that during this time frame, the stock did have a 58% drop in 2022. So it does show you that you go at Adobe and you go 10% drop is a buying opportunity. However, you can see if we were to hit a bear market, there's no doubt in my mind that Adobe would be dropping a lot more than this. So it depends if Adobe can hold this premium valuation or if it does lose the premium valuation ultimately. But when I look at Adobe here, I've factored in a buyback of the 25 billion, as you can see here. And now I've tried to put today's numbers in where it opens up. This has been a bit tricky because I don't know exactly where it's going to open up. So I've had a guess around where roughly it could open up, which is around about $505. And I've had a look at what level I could potentially buy Adobe at. So I put 10, 12, 14% revenue growth in. Obviously, we don't know exactly what they're going to grow at going forward. So there's a little bit of leeway to have there. Profit margins have been pretty consistent around the high 20% range. So I put 26, 27, 28% profit margin in. On a total earnings multiple, I put 20. I put the market average in to start with. Now on the market average, unfortunately, this offers no upside if you were to buy the stock, which is no surprise. If the stock was to then stop trading at a premium, which it does now, there's no upside at these levels. So that's something to be careful of, is if the market ever throws this stock under the bridge and puts it down to a normal market valuation, you're probably going to struggle to make money on Adobe. The thing with Adobe is that you are hoping that the company continues to grow rapidly, keeps the profit margin, and keeps trading at a premium valuation. So if we assume that Adobe always holds on to a 40 earnings multiple, then when you put a 40 times earnings multiple in, it does actually have upside from today's drop. On the low side, you've got a little bit of a leeway where you could make 30, 45% in the next 5 years. On the high side, you're up to 61, 80% on the high side with the share buyback factored in. So on the high side, if they were able to grow at good rates and the share buyback kicks in and it does trade at multiple, you could probably make money on today's drop. However, like I said, for me, I want to get great companies at great valuations, and I don't want to assume a business like Adobe is always going to be trading at a 40 times multiple. So for me, I look at Adobe and I've got to say, even with today's drop, I would rate it a buy, and if you do buy it, I think you'll do well in the next 5 years. However, for me personally, I want to get it at a great price. I want to get this great company at a great price. So for me, I would have to say that I would like to see the stock go a little bit lower from where it is right now. And if I was to factor in another 20% drop on the share price, which I've just done now, another 20% would actually put it towards, on the low side, 63% to 84% upside. On the high side, I get that 100% return that I look for. That's what I like to see when I invest into stocks. And if I update that now and put a 20 times multiple earnings in, on the high side, I'll probably still get out without losing money. So that has that little bit of a safety risk, a safety net if it was to drop to a low valuation, that I would still do, oh, well, I wouldn't do okay. I wouldn't really make anything from that investment, but there'd be that safety net there. So yeah, Adobe, like I said, from my point of view right now, I would rate it a buy if you are able to confirm that it does say at a multiple premium of where it is right now. For me, I'd like to get the stock at a bit more of a risk to reward point of view. I'd like it cheaper personally for myself, for me to go buy it. So I will wait on Adobe for maybe another 20% drop if it does get there, and then I'll probably start a position on Adobe personally. Because I look at it at the moment and the financials are doing, and there's a few stocks out there that I can think of already that I can get for nearly just over 10% revenue growth, same-ish sort of profit margins, and I can get it for probably half the valuation. So yeah, I mean, I'm a big fan of Adobe, but I've got to say, like, today's drop is good, but I think if I'm personally going to start a position, I need it a bit lower. But I don't think it's the worst stock to be looking at right now, and that's where I'm at with Adobe. So I hope you enjoyed the video and enjoyed me talking about where I could potentially buy it. So yeah, that's the video for today, guys. See you in a bit.